So now that you've learned a little bit about the history of Japanese trading, let's take a look at how some of these charting techniques started to evolve out of Japan. So what we discovered is we've discovered that obviously the prices are going to fluctuate a little bit here with the rice. As production goes up, production goes down, but you got a piece of paper that's backed by the rice. And so what's going to happen to the value of the paper? It's going to go up and it's going to go down. Well, the Japanese needed a way to track that. And so what they did is they started tracking those value fluctuations, and they started tracking the opening, the high, the low, and the closing price of the day. And they would map it out on a piece of paper, and they would start to track this, just like what we do here in the United States and in the Western trading world, and we have done now for several hundred years. But Japan was doing this back in the 1600s. That's what's kind of cool about it. As they plotted them, what they did is they started to develop a system for documenting the prices, and then before you know it, Japanese candlestick trading was born. So take a look here at these candlesticks. If you've been through Foundations of Stocks and Options or probably any of our other classes at TradeSmart, you should already be familiar with candlesticks, but I'll give you a quick introduction here. With what we consider a white candle, it's going to be formed by having the opening price, that's how the whole candle starts, and it trades vertically with the high price of the day being the upper part of the candle, the low price of the day, and then the closing price of the day representing the top of the actual candle body. Now the way this candle is drawn is it's drawn from bottom to top because we open down here and then we draw up. Now this candle is open, meaning that it's not colored in, as opposed to the black candle here. Take a look here. The way this candle is going to be created, we have the opening price. We still have the high and the low price of the day like you would normally have, but we draw this candle down to the closing price and to differentiate. So you have an idea if this is a higher close or a lower close, the Japanese would color this candle in, and they would literally color it in on a piece of paper. And the result is it looks like you've got white candles and black candles. That's where the history of white candles and black candles come from. It's actually an open or a non-colored candle versus a candle that has been colored in. Of course, since you're using pencil or black ink or something, it ends up looking like a white and black candle. So this whole notion of red and green candles that sometimes we see in our modern charting softwares, that's totally has nothing to do with Japanese trading at all. The black and white is exactly how it originally was created because it was filled in if it was a lower close than open. All right, so the black candle is actually a full and a white candle is actually an open candle. As we think about candlesticks, candlesticks were used to track the trade. And what's interesting is the picturesque nature of the candles. They tell a story about the trading sentiment. For those of you who've been through our candlestick training, you certainly understand that. Candlesticks give us a story. And that's a really big theme and an important theme in Japanese history because the Japanese culture was one of storytelling, not necessarily so much black and white facts here. And so the picturesque nature of the candlesticks relays a story, and it's that story that helps to tell the sentiment of what's happening behind the trade as it's being revealed through those candlesticks there. The result is a very visual form of trading based on the fluctuation of what people were willing to trade for, not necessarily what they thought it should be worth, but rather what people are willing to trade for. Now think about what I just said there, and look at this. I put it up on the screen separately. A very visual form of trading based on the fluctuation of what people were willing to trade for. Now what does that sound like? What does that remind you of? That's almost exactly the definition of technical analysis. But you realize that this was coming out in the 1600s, a couple of hundred years before the Western, New York Stock Exchange wasn't even dreamed up yet at that time. Western technical analysis, Charles Dow, didn't come around to the late 1800s. This was a couple hundred years before that. And basically, it's the exact same definition, a visual form of trading based on the fluctuation of what people are willing to trade for. Take a look at this candlestick chart here. One of the earliest forms of technical trading is, in fact, candlesticks. It's the most developed early form of technical trading. When you look at all the early forms of technical trading, candlesticks is definitely the most developed. And guess what? It's just as valuable today as it was in 1710, as it was in 1750, as it was in 1810. It's just as valuable today. It's a very, very valuable form of trading. And the reason is because it depicts in pictures what the trading sentiment is of the instrument that you're trading. The Japanese discovered a way of charting this and some pictures that could go along with it that really has never been matched since it was developed in the late 1600s, early 1700s. It's never been matched in anything that the Western world of traders have put out. That's why today, here we are, 21st century, and we're using Japanese candlesticks to map out really the day-to-day, and if you're an intraday trader, the minute-to-minute sentiment of that trade. Take a look at these pictures here. These are some of the examples. We've got a tweezer top. I'll just kind of list through some of these. So you got your tweezer top, you got your evening star reversal, bearish engulfing, you got your one black crow, you got your bearish harami. Those are some of the bearish variations. Then you look at the bottom, you got your tweezer bottom, your morning star reversals, bullish engulfings, your one white soldiers, and of course your bullish haramis here. So these are just some of the patterns, and these patterns tell a very explicit picture of what the sentiment is, and it helps traders as they're recognizing what the likely move is that's coming up next. Now when we think about candlestick evolution, that leads us into a discussion about a guy I'm going to introduce you to. Here's a picture of his book, Sokyo Homma right here. And candlestick trading, by the time this book was out in 1750, it was very well established. It had evolved into a complete form of technical trading. In fact, many of those developments that they started developing in the 16 and 1700s, they're almost identical to what the Western world developed a couple of hundred years later. For example, chart patterns. Here in the United States and around the Western world, we trade chart patterns. We have things like triple tops and triple bottoms. Well, so do the Japanese. They just called them three mountain tops or the three Buddha top. These are some of the variations that they had. And so, it's interesting that a couple of hundred years before Charles Dow, a lot of these ideas started to get established in Japan, but it was kind of kept under wraps because, again, that centralized government was trying to keep everything contained on the island rather than letting the rest of the world know about it. Well, there was a very famous trader by the name of Sokyo Homma, developed a system called the Sakata method. You saw the cover of his book on that last screen there. Sokyo Homma is known as the greatest Japanese trader ever. In the United States, he kind of has the legendary status of like a Jesse Livermore. If you're familiar with that name, Jesse Livermore is kind of known as one of the greatest traders ever. Sokyo Homma kind of has that reputation. It's been said that he placed over 100 consecutive back-to-back trades for a profit. So he's got all sorts of legends that live about it. But Sokyo Homma, not only was he a famous Japanese trader, he wrote a book that started to codify all of these techniques. And the name of the book, it's a little weird, it's called The Three Monkey Record of Money. And that's the way that it translates, The Three Monkey Record of Money. You saw actually the cover of it there on the last screen. And something interesting that Homma argues for is he argues that the psychological factors are the reason for the price movement. Now, why is that interesting? Well, as technical traders, we make the argument that trading psychology, trading sentiment, also known as speculation, the way people feel about a trade, that's the real driving force. We make the argument as a technical trader that everything that's known fundamentally has already been factored into the price of the stock. Sokyo Homma was making that same argument a full 150, if not 200 years before Charles Dow came along and said the same thing. So I think it's interesting. Sokyo Homma really is probably one of the earliest fathers of technical trading, even though in the West, Charles Dow gets all the credit, and certainly he deserves all that great credit that he gets. But I think it's fascinating that some of the greatest traders in history at the very beginning, they weren't trying to come up with these calculations of what the rice should be worth, but rather some of the greatest traders in history were recognizing that it's the sentiment, it's the way people feel about it, it's those psychological and emotional factors that have as much as anything to do with the fluctuation of those prices. So all of that Homma stuff, that's kind of where the Japanese evolution of trading started to come from. Throughout the 1800s, the techniques started to evolve. There's going to be some other techniques that maybe one day we'll come back and look at. For example, the Keigi charts, Renko charts, three-line breaks, Ikenashi. These are all kind of variations of the Western point and figure charts, if you're familiar with point and figure. And so maybe one day we'll come back and look at that. But in 1940, an evolution came along that was really distinct, and that's where the cloud charting comes along. So that's what we're going to look at in the next video, the genesis of these things that we call Ichimoku clouds.